You know what? I was in a spelling, I don't know if I told the story to you before. I was in a spelling bee and I got down to like the final three. I was like, I got this in the bag. My spelling is good. The word was extraordinary.
Okay.
Which is pretty simple. It's just extraordinary.
It is. When you pronounce it like you do, it makes it more hard, more challenging. But okay.
So I was like, extraordinary. That's easy. Extraordinary. I spelled it and I got the ding incorrect.
Oh, you got it. Yeah, ding is bad.
I was this close from
But
making
how
something
did you
of my life.
imagine that? Can't believe you had to fall back on financial planning.
Remember that song, We Built This City back in the 80s or 90s?
On rock and roll?
Yeah. Either me or my brother, one of us used to sing the lyrics, we built this city and it needs more salt.
I don't know if that's a classic singing along wrong song, though.
Yeah, I'm pretty bad. This morning, Blinded by the Light came on.
Yeah.
And that one, for the life of me, still don't understand what the lyrics are about.
Blinded by the light.
Revved up by the deuce, another.
By the deuce.
Welcome to another exciting episode of Talk Your Chart. I am Brett Horowitz here with the esteemed Marco Segura. This is episode number 26, recorded on November 30th, 2022. Last time, Marcos, we ended joking about average, what the average bear market looked like. I thought it'd be funny that if we had Elon Musk in this video with us, on average, we'd be a billionaire, all of us.
That's true. Gotta love how numbers work.
But you know who's not average? Women. Women are not average. And obviously, you're going to say, of course not. We know that. But when it comes to investing, women are better than average. Because if we look here at this first chart, it really shows that on average, women earn more than men. Why? Because they trade less often.
Wow. That was a smooth pivot to the woman compliment. I was wondering where that was going. I like this.
So I think, oftentimes clients will ask me, and I'm sure they ask you too, what are you guys doing in light of all the craziness that's happened in 2022 and what they expect in 2023 with the recession? What do you say when someone says to you, are you guys making major shifts? Are you changing because of what's happened year to date or going forward?
No, knee-jerk firing off the cuff. You know the line I use. Ultimately, you never want to make a move that is in response to headlines or what the market happens to be doing at the moment. It is not an indictment on the market if it isn't doing what you want it to do when you want it to do it. That's the answer.
Yeah, I mean, I think that most people feel like they need to do something. I mean, it's the hardest thing probably to resist is when the markets are going haywire. How can I just sit back and not do something?
Action bias.
Yeah.
Yeah.
But you know what, in honesty, though, most of those moves that you make are going to be made looking at backwards. Obviously, the markets are looking forward. And so in order for you to make a move that's going to be of significance and make sense, you got to use knowledge about the future, not knowledge about what's happened already in the past.
Yeah, absolutely. I think you've seen it before in practice, unfortunately, and so have I. When markets are moving wildly in either direction and you make a big move and you have a ton of conviction in that move, it's almost 100% of the time it ends up not working out. The market will humble you, and it will humble you quickly. I think we're now experiencing that with crypto, right? The crypto fallout has been unfortunate for many. It's funny to see how many people are coming out now kind of saying, oh, I told you so. I knew it. I knew this would happen.
And so we talked about all the things that, you look backwards on that have just gone haywire over the last year. You've got a great chart showing some things that we've experienced in the last 12 months.
Yeah. So this is Tom Lee at Fundstrat. And I love this. They do good graphics with the little smiley face and everything. Coming into 2022 and the first half of 22, that left side of this chart is telling us all the things that were going wrong and we're going to absolutely just trash us from a market and economic perspective through all of 22 for at least 22. Who knows how long it would last. Juxtapose that to where we are right now. So they're framing this as headwinds becoming tailwinds. It's interesting, the inflation print, because technically, if you use the month over month CPI prints, we're now annualizing at closer to 3%, which means the federal funds rate, which is now at 3.75 to 4, low bound and upper bound, well, that would mean the federal funds rate is higher than forward expected CPI, right? And that's where we've been trying to get to for the last 12 months. So again, things can move quickly.
Well, I think everyone's counting on the fact that there will at some point be three pivots. A pivot from skyrocketing Fed funds rate to moderating Fed funds rate to stopping the Fed funds rate increase and to finally dropping it potentially. And so again, backwards looking versus forward looking, you look at this and say, my gosh, it's been a horrible year and all these things are going wrong. Yes, but that's in the past. Let's move forward and think about all the things that could go right in 2023.
Yeah, it's hard. And also, Brett, to speak to it, outside of the COVID recession, if a recession happened next year, it's got to be like the most bright spotted, headlighted, heads up recession coming next year, which I'm on record of saying recession 2023. If I had to give you a reason why I'm going to change my take, it would be because everyone thinks it's going to happen. Everyone.
I don't know why anyone would be surprised if it does happen, or why the markets would even react if it does happen, right? To me, it's a complete yawn. If I said to you in 6 months from now, you're going to get a major cold, in June, and you get a cold in June, you'll be like, whatever, Brett told me it was going to happen. Like, everyone thinks it's going to happen, like you said. Everyone's completely bearish on it happening.
So you hit it. So next, let's go right to the next chart. You see it here. So the next one that we're looking at, sentiment. Everyone is still grounded. And this is not just retail. This chart is specifically for retail, but you can see institutionally lowest equity allocations in a while. This chart, though, is talking about how incredibly bearish retail sentiment is right now, looking all the way back to 1988.
Well, existing clients who have money with us have said, I want to shift my allocation because of the recession. New clients who have cash say, I don't want to get in because of the recession coming in. And I'll always say to them, look, if you knew a recession was coming in 6 months, you don't wait for that day to happen and then get out, right? As we've seen in other charts that we've shown in past episodes, markets move well faster and well ahead of the recession.
Exactly. So look, we've hit a max bottom right now so far, 25% drawdown. Average bear market closer to 36. Do we get to that 36% bear case? I'm just going to assume yes, so I have proper expectations, but I'm just not surprised if it doesn't happen because it feels like we're consolidating a bottom because of how much pessimism is out there. And let's look, rolling right into that next chart, historically, which again, it's some signal, but by no stretch a guarantee, by no means a guarantee. Forget the lines, right? Yeah, the lines from that rebase to 100 line down the middle of this chart, they're moving up. What does that mean? This is just showing the correlation of negative sentiment going into year end and how the markets respond over that same period of time. And the answer is up.
Well, it's not just consumers who are negative. It's also, you listen to almost every earnings call of every company, and they're expecting lower earnings next year. They're expecting some kind of a slowdown in consumer spending. And so every company is already, out there in advance saying, our stock price needs to be adjusted for the fact that we all see this coming. So it's not as if the consumer is pessimistic and the market is optimistic. Both, I think, are pessimistic at the same time.
Well, history is on our side.
Yeah.
And it's not that we're expecting Pollyannishly only good things to happen all the time. Not at all. I think we're both incredibly aware that markets experience pain, perhaps for extended periods of time before an eventual recovery. So I don't think we're here saying that markets can't fall and they can't fall for a while. But you say the stats more than I do. 3 out of every 4 years, the market's up. So for us, and our job as advisors and fiduciaries, if you want to use the F word, it's helping frame these things to help you realize that the good times don't last forever and neither the bad times. And thankfully, from a probability standpoint, the good is usually longer and of a much higher degree than the bad.
3 out of 4, that's the stock market. So that's 6 out of 8 years it's up. Bonds are even higher, 7 out of 8 years it's higher, right? So the odds are in your favor that most years you're going to be making money in the stock market and bond market.
Yeah, exactly. So quick pivot here, but same market that we're talking about. People saying, okay, we get it. We could get a rally into year end, and then the market might pull back if we get negative real GDP prints and maybe Q1 or Q2 of next year. Right now, Q4 GDP looks like it's going to be positive, but some people are saying valuations are still just not where we want them to be, right? So Brett, talk to me here about valuations and what they mean. How predictive are they over any short period of time?
Well, I think that the chart here shows a 1 year, the forward PE, which is price to earnings, basically tells you how expensive the market is relative to how much you're paying for it. And the higher the PE, the more expensive the market is, the lower the PE, the cheaper it is.
Yeah.
And on the left side, it shows the following 1 year return based on what the PE ratio of the market is. And on the right side, the 5-year return, what the market is. And without looking at all the dots, which are maybe a little bit more random on the left side, the point of the chart and the R squared number at the bottom simply shows that no matter what the PE is, it gives you no indication of what the market return will be over the next 1 year. However, going forward 5 years, it's very clear that the cheaper the market is, the better the returns will be going forward, and vice versa.
Yeah, exactly. So I think, look, higher PE ratios over a 5+ year period, you expect lower, kind of lower than average, so to speak, returns, but still positive, right? If you're looking at that 5-year chart. And then over a 12-month period, total crapshoot. Right. Not a good indicator for 1 year returns.
Yeah, you can't go look at this and say, well, the market's overvalued now, so it's got to fall the next year. No, you could have, I think the most glaring statistic I remember was in 1996 is when Alan Greenspan talked about irrational exuberance because the market was frothy. It went up 107% in the next 4 years. So market can be high and then keep going higher for a lot longer until things finally settle down.
Yeah, I hear you. Speaking of Fed Reserve chairs, I still got our man on the wall right there, smoking his stogie, waiting. He says Jerome's not going hard enough.
But it's not only Jerome that's having these conversations, it's every federal central bank that's out there in the world. It's not just a US inflation problem, it's a worldwide inflation problem.
100%. And thank the Lord, it's always a relative game in the global economy. Because yes, should we have GDP, debt to GDP ratios above 100%? I don't know. I'd say probably not. But thankfully, when you do that ratio, you're not looking at the US in a vacuum. You're comparing us to everyone else.
Well, you shouldn't, but I think a lot of investors do. They like owning US companies. There's a US home country bias that most investors have, where they'd like to know what they own and not own companies they never heard of. And so I want to show a chart here that looks at, we're going to look at the bottom left on this chart here first, basically showing all the assets that have flowed into US equity funds over the last few years. Why? Okay. Because US has dominated foreign over the last 10+ years. And so money obviously flows into what's done well, usually at the wrong time. We'll see about that. But you can see then on the bottom right that the US is still overvalued compared to foreign. And as part of the result of this may be, we're seeing the first signs of US weakening as we look at the performance year to date of the US versus Europe and Japan and other places.
This is awesome. I'm gonna add to that. I'm gonna compound, right? So let me take what you said. Let's build on this. So the US outperformance has been for 15 years. Before that, outside of the US outperformed for 7. Then before that, the US outperformed for 6. Before that, international for 2. Before that, US for 4. Before that, outside the US for 6. So again, why am I saying all this stuff? Because it's going to change at some point. And a 15-year streak, good for you if you made that call.
Well, we've heard it before from other people. Vanguard has been projecting foreign to outperform. We've been talking about it to a lot of clients saying, this can't last. The US has done so well because of technology companies. It's done so well because of our currency, appreciating. But those things got to turn at some point. The tech companies are now expensive and our currency is going to weaken.
The last 20 years for sure, and then obviously reflected in the last 15 years of outperformance by the US, it's been clear that our domination in the large money printing technology companies has helped this happen. And again, not to take the counterpoint, because it's not like we're putting money on red or black here, international US. It's always a balanced approach. Boring is better, as you and I would agree. If you try to predict these things, it's just not going to work. Vanguard, State Street, BlackRock, they've all been saying this for 10 years, that they're, international outperforming. Eventually they'll be right. But again, it's not predictive in nature. All they're doing is saying based on what's come before us and based off what we see going forward, here's an educated guess.
I think probability is also coming to play with bonds, because I know that everyone is going crazy with how bonds have done so poorly this year. Worst year going back to 18 something. What was the number?
18 like 20s, man. Jason Zweig for the 1800s. Cowboys and Indians, dude.
I wasn't around there, but I
Not
think
quite.
I think what we see here is what would happen with the interest rates, how high they'd have to go in order to get another repeat of what we've seen so far this year. You're talking about rates having to rise another 4+% to repeat what happened in 2022. And as long as they stay relatively flat, or even go up a little bit, or even go down, you should see finally some big returns in bonds. And I think then the bottom part shows you just how rare this 4 to 5% increase in rates has been over time. 0% change in rates and 8.5% return. I mean, that would be fantastic for a lot of clients who over the last few years have gotten no return from bonds.
Yeah, so we'll see. So look, this, as if you're constructing portfolios here, this gives you an opportunity to lean back into quality, right? Where most people were going away from quality to get some type of yield. What this does is put a ton of pressure on the Tina effect.
Right.
There is no alternative, meaning everyone was kind of just slamming into stocks because where else were you going to go? Well, now with the S&P 500 yielding just under 2% and a 2-year treasury yielding what, like 3.5%, something like that? Over 4. Wait a second. There's an alternative now. Right. So I think it's an entirely different world you're investing in now from a bond perspective compared to a year ago, right? Even less than a year ago.
You know, I think the pain that someone experienced in bonds is probably near the end of what we've seen. And now you're going to be able to get a fairly nice return on your fixed income investments. Same with cash and CDs and other things.
Yeah, exactly. Finally. And again, that's good for net savers. So Brett, I want to pivot quickly, I guess, kind of to what we were talking about before about recession, what has to happen for the Bureau of Economic Analysis to actually call a recession. A lot has to happen. Specifically, a lot has to happen in employment. We're still looking at historically low amounts in employment as far as like the level, right? 3.7%. I want to frame employment a little bit and say, okay, wait a second, why aren't things moving? Because all you're hearing about now are all these big tech layoffs, right? That's obviously the sector of the economy that's getting absolutely hammered. And what this chart shows is the accounting, how much of a representation are technology jobs as a percentage of total employment. And as a total sector, it's under 3%. And the ones that we're all really focused on, the Metas and the Googles and all that type of stuff, that's the dark blue piece. That's less than 0.5% of your entire workforce. Now, the fair question on the other side of this is, what does that represent as far as buying power? Good point. I have no idea, but I'm not going to be too worried about it just because of what this chart is showing me. So I think, yeah, all the tech sector companies can lay off as many people as they like. I don't know not that I don't know. I really, really doubt that that's going to be enough pressure to make unemployment increase any meaningful fashion.
Well, we're seeing it. We're seeing unemployment rate not change. We're seeing the unemployment every Thursday. The number of new people filing for unemployment benefits isn't changing. So, yeah,
and I just think, and people, I think the headlines are true of people are hoarding employment. And this goes back to the psychology of the recession. I think based off what I've read and heard, business owners are looking through the next recession and saying, on the other side of this, I need to be prepared to meet the demand of my customers. I can't afford to get rid of good employees because it's already hard to find talent. I don't see it getting any easier post-recession.
You're going to keep the workers you have, and you're not going to lay them off just to hire them back in 6 months.
I know. So so last chart here, more labor stuff. Hit me with your thought. How much weight do you put? How much do you care about the LinkedIn factor saying job market not as tight as what the conventional measure of job markets would be? Do we trust LinkedIn here? Or is this just a fun stat to look at?
Who knows? I mean, look, over the last few years, no one's been able to understand why the labor market is where it is, because you've got all this gig economy. You've got people that may have retired or may have just stepped back because of COVID, but will come back to the workforce. No one seems to understand why employment hasn't changed and why participation rate hasn't changed. So I don't know if I believe LinkedIn or not. If they're around for 30 years, maybe I'll start to believe them at it. in the future, but it's too early for me to say. I'm all
Yeah,
in.
I agree. I have no idea. I believe Harvard Business Review, and that's where I pulled this from. So there you go. For what it's worth, Harvard Business Review looks at the LinkedIn's measure of active job openings to active applicants, and not showing as tight a measure as your conventional ratio of job openings to unemployment. So
Yeah,
there you have it.
While you can say you can't believe what government reports, we're not living in Cuba or China where government tends to report things just that are positive. So for the meantime, I'm going to go with what the government says.
Put the difference, I'll go somewhere in between. So not as tight as the government, but not as loose as LinkedIn.
Okay.
Fair enough. 50-50.
Well, Marcos, have a great birthday today. You turned a wonderful age today. Enjoy your big
Halfway to
day.
70. Halfway to 70.
Let's do it again, brother.